Good morning, good afternoon, good evening. Today we are going to start with a new topic, that is gross income. All the incomes which you are going to see on the 1041st page, all the gross incomes, all the interest income, all the dividend income, all the retirement related income, social security benefits, rental income and expense, business income and expense, and any additional income, we are going to look into this chapter. So just this is a disclaimer, it's just a revision lecture. Okay, so we are going to do a quick revision with main parts, main important things to remember in the exam point of view. Okay, so first one is wages, salaries and other income. So main income, when a person is going to file a 1040 return, the first line of the 1040 is the W2 income. Okay, so when you have a wages income, salaries income or any other earning, how it will be taxable from the point of view of employee, from the point of view of employer. For employee, it will be included in the gross income. An employee should attach a copy B of W2 form with the federal income tax return, that is 1040 return. Second thing is, some of the employee might receive 1099 NEC. So there was a question based on this in the recent exam. So 1099 NEC, who will receive a 1099 NEC when a person is not a employee? Okay, they are just working on a contract basis, right? So let's say if Mr. X is working on a contract basis providing services at ABC Corporation, so they will not issue a W2 to him, right? Because he is just working on a contract basis. That's why he will be called as a non-employee. And for mentioning his earnings, they will have to issue a 1099 NEC to him. So if received 1099 NEC, non-employee compensation, because their employer did not consider them as an employee, then you have to use form 8919 to report uncollected social security and Medicare on wages. Okay, so just like a W2 form is issued, you are going to pay the payroll taxes, right? The employer's responsibility is there to collect the payroll taxes. The 50% portion he will bear, 50% the employee will bear, and deposit it to the IRS, deposited the SUTA to the state government and FUTA to the federal government, right? Same way, if you're not an employee, employer will not, like the person who is paying you, the ABC Corporation who is paying you, will not be liable to deduct any Medicare, Social Security, FUTA, federal income tax and anything, right? They will withhold certain percentage, but exactly the Medicare and Social Security percentage, right, 15.3%, it's your responsibility who is receiving NEC, their responsibility to deposit this amount. In which format they will deposit it? This form number came into the exam, this NEC related questions came into the exam, so please mark it as an important. 8919 form will be used to report uncollected social security and Medicare tax on wages. All right, now employer is nothing, is just going to report annual employee compensation to the employees on the W2 form. At the end of the year, whatever earnings the employee might have earned from Jan to December, they'll just report it in the form of W2 and provide it to the employee as on 31st of January till 31st Jan, after the end of the year. Okay, now second thing is, also the employer can provide them some scholarship, fellowship, grants that were not reported to the taxpayer on W2, and now this year this is an amendment that they will be reported on Schedule L, line 8R. Okay, sorry, Schedule 1, line 8R, they will have to report the scholarship, fellowship, grants if they are receiving from the employer, but it is not reported as a taxable wages, right? As per the law, we will see it later on, that when you receive a fellowship, scholarship, grant from your employer, it's not taxable, so it will be reported on Schedule 1, line 8R, right? Second one is child care providers. Now employee receives the benefit from the employers, that instead of paying the childcare facility, employer will pay the childcare facility on their behalf, or employer can provide a childcare facility just below their office or surrounding to the office, so that the people, the employees can come over and have a proper workplace. They should not worry about the child, right? So employee will include it in the gross income, and if not an employee, must include the payment for services on Schedule C and complete Schedule 1. Okay, Schedule C income will get flowed to the Schedule 1. That's it. So childcare facility is this. Foreign income, if you're going to receive a foreign income, there are two scenarios. One is residing in US. Okay, if you're having a foreign income, you're residing in US, first one is you must report the income from the sources outside the US. Whatever income you're receiving from outside the US, so that's your foreign income, right? Being a resident person. So you must report it as a foreign income on the income tax return, unless it is exempt by the US law. Okay, now being a US citizen and a resident alien, if you're having earned plus unearned income from foreign country, you have to report it on the your 1040 return as a foreign earnings. Now let's say if a person is residing outside US, you may be able to exclude all or part of the foreign source earned income. Earned income you can easily exclude if you're receiving it from outside US and you are also staying outside US. Okay, so that is one foreign income. Next is advance commission. Whenever you receive an advance commission, that will depend on whether the person is using a cash method or accrual method. So under the cash method, a taxpayer receives advance commission or any other amount for future services must include it in the income in the year where it is received. If a person is using accrual method, any advance commission they will not receive, they will not record it unless their services are accrued. Okay, next one is cost of living allowance and reimbursement. If employee is receiving the cost of living or any reimbursement from their employers, so this is an incentive for taking a less desirable assignment, are a part of compensation. Okay, let's say they are given a compensation for non-compete or for XYZ reason, then for taking a less desirable assignment, if they receive a compensation, so this is considered as their income. Okay, and it will be included in the income. Next, for any other, it will be included in the income. This is excluded only for one person who is a federal civilian or a federal court employee and who is stationed at Alaska, Hawaii, or outside the US. If these three locations they are going to stay and have their employment over there, and in that case, if they receive a cost of living allowance and any reimbursement for, let's say, travel or any reimbursements if they are going to receive, then it will not be included. Only the conditions you have to remember. See, whole part 1 is based on conditions, criteria and all. Limits are not useful. Okay, limits are not going to be used anywhere in the exam. If you're logically sound and you know all the criteria, then only you can easily clear the exam. So only one criteria, one exception is normally cost of living is not included. One exception is if you are a federal civilian, federal court employee who is stationed at Alaska, Hawaii, or outside United States, then it will be not included in the income. Okay. Next is back pay. What is back pay? Let's say after you quit the job, after that you receive some payment for your previous months, or let's say after 3 months you receive the whole amount of salary, and middle of this 3 months there is an end of the year. Okay, so you receive the pay for the previous year. In that case, whenever you receive it, included in the income, right? Employer will report it in W2 while paying. Let's say for the month of November, the salary is paid in the month of February. So November month salary, when it was not paid, it was not included in previous year. Now you will include it in the year in which it is received. Okay, so this includes the payment. What all things will be considered? Let's say damages. For any damages, there are court cases going on. Okay, employment related some damages are there, and after the conclusion of the court case, the employee is going to receive some amount, so it will be considered in the back pay in the W2 wages in the year in which it is actually paid, right? Unpaid life insurance premium, unpaid health insurance premium, these three things will be, if paid right now, will be considered as a back pay and will be included in your income. Okay, next is bonuses and awards. There can be one question based on this. When an employee is going to pay, employer is going to pay some bonus or any award, straight away included in his income. If it's a cash, straight away include the cash. If it is just goods or services or any property if you receive, straight away include the fair market value in the income. Okay, and what the employer will do, straight away employer will report it on the form W2, right? Next is severance pay. What do you mean by severance pay? Employee, due to cancellation of employment contract, must be included in the income due to the cancellation of the contract. Let's say employee breached the contract or employer breached the contract, and due to that he is going to receive some extra payment for the layoff or something like that. Okay, so severance pay is something which will be received based on early shutdown of the employment or cancellation of contract. So see, here it is mentioned, this includes any payment received for accrued leave or monies withheld from the severance for outplacement services. Or let's say the employer has withheld certain portion of the amount. Let's say in probation period you were promised to pay X amount, okay, but you were not given X amount, you are going to get a lesser amount because of probation. As soon as the probation will end, you will receive that accrued amount, that withhold amount. So that is your severance pay, and it will be included in the income. Okay, so include the unreduced amount of severance pay in the income. Any expenses or anything which is like, let's have from this accrued leave, if they are claiming some expenses because of your employment, or you have taken any leave or extra things, but ultimately you are going to receive, suppose $100, include the exact that amount which you are going to receive in the form of severance pay. Okay, next is sick pay. Whenever a person is going to receive a sick pay, that will be taxable. But what do you mean by sick pay? Like, what employee must include in the sick pay? Like, when they receive anything from all these funds, what are these funds? Welfare fund. Okay, the payer is a welfare fund, or a state sickness or disability fund, right? An association of employers and employee, they might create an association, and anyone who is going to have a sick pay, okay, there are some specified number of days on which you can have a sick pay, or specified number of hours which are allowed for the sick pay. Means while you are sick, while you are on leave due to the sickness, you still receive the payment. Okay, so you are still receiving the payment, it will anyways be included in the income. This payment is received from these 4 categories. One is welfare, state sickness or disability fund, association of employers and employees, and the 4th is insurance company. But please mark this word, you will be trapped in this word, that if any insurance company, if the premium was paid by employer when you were working, if you are paying the premium for yourself and now you are receiving the sick pay from the insurance company, then it is not taxable. Okay, got it? Next is disability income. Now, if a person is disabled, what will happen? It will be that person will be receiving the income. Okay, now it depends on 2 things. Who paid for that premium amount for the disability insurance? Who paid for that premium? Okay, those who are working practically, they might be familiar with this word, state disability insurance. Okay, so insurance premium is paid initially. After that, if you are disabled, or if the employee is not able to work due to some disability, temporary, permanent disability, right, then it will be taxable if a person start receiving the disability payments from that fund. When it will be taxable? If the whole state disability insurance premium was paid by the employer. But if only employee is paying, right, then nothing will be taxable. Only employee was responsible for paying the insurance premium, then nothing will be taxable. Now, sometime it can happen, employee plus employer both are paying for the plan. So taxable will be only the employer part of premium, and non-taxable will be the employee's part. Why the employee should spend the insurance expense also, premium expense, and when they receive the disability income, it should be taxable? This is unfair, right? So only the employer's portion will be taxable over here. Okay, see, they will give you the lump sum amount, you have to proportionate it. How much cost that employee incurred, how much cost that employer incurred, and based on that only employer's portion will be taxable, not the employee. One more thing is non-taxable, that is reimbursement. If you're receiving the reimbursement for the medical expense incurred after the plan was established. Okay, insurance plan was established, let's say in 2022. And now you started getting the reimbursement for medical expense because the plan was established in 22 and in 23 you didn't join the plan, but after that you start receiving the medical reimbursement. So that medical reimbursement is also not taxable. That you will see later on in the injury and injury awards. That thing we will see reimbursement received for medical and sickness. Okay, so just remember, in disability income, if a person gets disabled, please make sure to check who was paying the premium for receiving that disabled income. If the premium was wholly paid by the employer, it will be taxable. If it is paid by the employee, it will be non-taxable. If it is paid by the employee plus employer, you have to do the proportionate. How much cost did employee incurred, how much cost did employer incurred, and the proportionate amount will be allocated to both of them, right? So this is disability income. Next one is accident or health plan. Just like a disability income, accident or health plan will be considered. Who was actually paying the premium? So health plan coverage, if it is provided by employer, it will not be included in the income. Okay, at the time of paying the insurance premium, it is not included. But yes, when you start receiving the benefit from that, let's say the person got sick, or if the person met with an accident and they are going to use the funds from the health and accident plan, then that benefit, when starts receiving, it will be taxable at that time. Okay, so please remember this thing, that anything in our part 1, wherever is employer-employee relation, please remember anything which employer will provide will be taxable unless there is an exception. The exceptions are all regarding your retirement plan, medical, health insurance, bonuses, awards, fringe benefits. Okay, so these are the main categories. Just go through these categories once. Okay, if you're not aware about the more criteria, go through the regular book, understand it very well. This is just a revision. If your exam is in next 7 to 8 days, then only you are watching this lecture. Don't straight away start with the revision lecture, else you will get confused. Okay. Next is fringe benefits. When it will be included in income, if it is received in connection with performance of the services. Let's say at office you are receiving the meals or some tea, coffee, snacks. So this is just at the time of performing the services, you are receiving that fringe benefits. Some small benefits are there. Okay, so if it is received in connection with the performance of services, and second is if it is excluded by the law and the employee paid fair market value for the benefits, then it is excluded, right? So abstaining from performance of services under a covenant not to compete will be treated as a performance of service for those routes. Okay, what do you mean by this? Like, just simply, let's say you and your employer are working together. Now employee wants to be separated and wants to start the same business which he was working at the employer's place. So that is a non-compete covenant. So the employer will pay a lump sum amount that you are not going to perform the services in the same field, same industry. For that they will get a lump sum amount. So when you receive that lump sum amount, it will be included in the income. It's not called as a fringe benefit. Okay, it will only be excluded if it is excluded by the law. We will see at the last of this chapter a small bullet points are there. What all things are not excluded and what all things are excluded by the law. Okay, if it is excluded, then no need to include. And if the employer paid the FMV for the benefits, let's say the person has received a statutory stock option, non-statutory stock option, right? And if the FMV of that stock option is already paid to the employer, then he is not going to again include it in the income. He is already paying for such fringe benefits, right? Next is group term life insurance. Now when an employer is going to get a group life insurance for 5 employees, 6 employees, right? Please make sure here, mostly the students make the mistake, coverage amount you have to check, not the cost. There are the two definitions. One is coverage and one is cost. Coverage means for how much amount the value of insurance is covered. Let's say the person, one of the employee died. Okay, so how much coverage you are going to receive. So for all the 5 or 6 employees, how much coverage you have agreed upon. If it is up to 50,000, then nothing is taxable for the employee. If as soon as the coverage is going more than, less than or equal to 50, nothing is taxable. As soon as it goes more than 50,000, it must be included in the income. How much will be included? Whatever is the cost which the employer has incurred. Okay, please remember just simple one formula. Let's say employer has taken the insurance policy which is going to cover 60,000. Can I say there is an extra $10,000 of extra coverage? Right? Now, employee has incurred $45,000 to take this coverage. So can I say employer has incurred $45,000 to take this coverage. So can I say employer's cost is $45,000 to take a coverage of 60. So 45,000 is for 60,000 coverage. So how much is for 10,000? So this much will be taxable. So let's see how much it is. 45,000 divided by 60 into 10,000. 45 divided by 60 into 10, that comes to $7,500. So out of your 45,000 cost, 7,500 is a taxable cost to the employee. See, any benefit provided by the employer to the employee is taxable except the exceptions are mentioned. So here, when an employer is going to take a group term life insurance policy, it is non-taxable except if the coverage exceeds 50,000. Here the coverage is exceeding 50,000. Here the coverage amount is 60. So you can't straight away charge 10,000 as a taxable. You have to proportionate it against the employer cost. How much employer is spending? How much is the employer's cost? You have to find out that. And based on that, how much will be taxable? Out of this cost, how much should be considered as a taxable for the employee? Okay. So here one thing is provided by the employer or the former employer. So employer must report the amount included in the income as a part of wages. Box 1, you will be including whatever or this cost you are going to make it taxable to the employee. It needs to be included in the W2. Why box 1? So based on that, federal income tax will be considered. Okay. Now employer paid premium for whole life or permanent insurance are included in the employee's income. If employer is going to pay for whole life, for full life, okay, see there are two types of insurance unless the person is working with the employer. Also, there is some of the insurance policy which will be in the name of the employer only, right? So even if the employer leaves the organization, they will not carry on this group term life insurance policy. It will be limited to the employer. But some of the insurance policy, if those are promising the whole life or permanent insurance, then straight away include it in the employee's income. The cost you need to include are not the coverage. So don't get confused between the coverage and the cost. All right. Next is restricted property. Restricted property means there is some restrictions to sell that particular property. So it will be taxable in which year? In the year in which it is granted. So taxable in the year of grant date, right? And second, it will be taxable in the later year if you make a election. That is 83B election. Let's say you received a property, but it is having a vesting period of 3 years. Vesting period of 3 years. Now you know this is an appreciable property. After 3 years, I'll have to include a huge amount into my income because straight away FMV you're going to include, right? FMV of the property received is included in the income. If employee is going to receive a restricted property from the employer, the grant date is, let's say, 1/1/2023. But the vesting period is after 3 years. So can I say if it's an appreciable property, after 3 years, you will have to pay a huge amount of tax. Also, after 3 years, your tax liability will be on the higher side, plus the fair market value of the property is on higher side. So IRS has given an opportunity. Either you can pay the tax in the year of grant date at the same tax rate which you are right now in same slab rate by electing 83B. Okay, and this election has to be made within 30 days of the grant date, right? So taxable in the later year if certain restrictions affect its value. So taxable year will be the later year when it vested. But you have one benefit, you can take a 83B election and make it taxable in current year. Okay, so IRS treats restricted stock dividend as a compensation and not as a dividend income unless taxpayer has recognized the stock as an income. This I have explained very well in the class. Just a quick overview I am giving. Let's say you have received a restricted property and that property are stock. Okay, just a minute. Yeah, that property is stock. Okay, so what will happen? This stock is, let's say, paying dividend. Now you will say that since this is not my property yet, I should not include the dividend income in my income, right? Everyone will claim that. So the thing is, IRS will treat this restricted stock as treat restricted stock as a compensation and not as a dividend income. So on this stock, even if you receive a dividend, right, since you're not a main owner yet, it has not yet vested, so this dividend will not be called as a dividend, it is called as a normal compensation, because you are receiving a compensation on the restricted property which employer has given to you, the stock. Okay, the stock which you have received is not yet vested in your name, right? So whatever dividend you will receive, it will be called as a compensation, not the dividend, unless it is vested. But yes, if you do this election, you record it right now only that this is the FMV, this I am recording it as an income, then it will be considered as a normal dividend income. Okay, got it guys? Next one is stock option. Just like a restricted stock, let's look at the stock option. This is also important one. You can just have a look at this chart and that's it. Okay, no need to do whole theory from any material. Just read it, look at the chart, and you will be easily be able to remember the topic. Okay, yeah, see, non-statutory, non-qualified. Okay, statutory or qualified or incentive stock option. So these are the two categories of stock option. What is stock option? You will be given an option. Just think like it's a ticket. It's a ticket to buy the shares and securities. Just like that, this stock option are just a ticket you are receiving right now. Okay, now after 1 year, after 2 years, after 3 years, you can easily buy the shares and securities of the company. Let's say you are working, you are an employee, you are working for this employer. This employer will issue you the stock option for buying the shares and securities of the same organization. Okay, now whether the share is whether the stock option is statutory, non-statutory, you don't have to decide it. This condition, like whether it's statutory, non-statutory, totally depends on the conditions, criteria is applicable to the specific organization based on the number of shares, based on the paid up share capital and all. So that's not there in your syllabus, no need to remember. And if you want, you can just do a research on it, what kind of shares will be statutory and what will be non-statutory. Okay, so based on that, if you receive a non-statutory, non-qualified, as the word says non, it will not give you any benefit. As soon as you receive it, it will be taxable. Okay, so the option is treated similarly as you have received any other property. So as soon as you receive this, just think like in restricted property, you have seen it is taxable on the grant date. How much amount it is taxable? FMV, right? So stock option, if you receive a non-statutory, non-qualified, straight away the option is treated as similarly as you are receiving any other property, and it will be taxable at a FMV. Now on what date you will be take the FMV? FMV on the grant date is available, then straight away take the FMV. But let's say you don't have the FMV, it's a new stock. No one is aware about the stock yet in the market. We don't have a readily available fair market value. No one has yet traded in this stock option. So what will happen? The time when you exercise this option, at what price you exercised will be included in your income. Okay. Next is, let's say you don't exercise it. You are going to sell it to, let's say, your colleague or some other person, third party. Straight away you're selling the ticket to purchase the stock, right? To share, ticket to purchase the shares. So that stock option, you're straight away selling it to someone else at whatever price you're going to sell it. That will be your income in your tax return if it's a non-qualified. Okay, now simple, the another meaning is if it's a statutory incentive stock option, means if it's a qualified stock option, employee will not have any income until they sell or exchange the stock. Right? So statutory stock option is what? Incentive stock option. Employee will not have any income until they sell or exchange the stock. Means it will have the benefit, like as soon as you receive the ticket, as soon as you receive the stock option, you don't have to include it in your income unless and until you buy the stock, and then that bought stock when you sell it in the market, right? So employee will not have any income until they sell the exchange the stock in the market. Now one more thing you have to remember, when you sell it, whether it's your capital gain or whether it's your ordinary gain. You have to figure out that thing, right? How you will figure out? Check that whether you are selling this shares after 1 year from date of exercise and after 2 years from date of grant date. If yes, it's a normal capital gain. Again, I'm repeating, if you're selling this shares, stock, securities which you have bought from the stock option, if you're selling it within 1 year, like after 1 year, not within, after 1 year plus 2 years from the grant date, 1 year from the exercise date. I hope everyone understands the meaning of exercise and grant date. Okay, after 1 year from the date of exercise plus more than 2 years from the date of grant date, then it will be called as a normal capital gain. Right? If these two conditions are not satisfied, it will be considered as a normal ordinary gain, and only the difference is if it's a capital gain, it will be applicable for a preferential treatment. If it's a short term, it will go to normal. But yeah, since it's more than 1 year of the grant date, more than 2 years, anyways, it will be a long term. It will have a 0%, 15%, 20% slab rate, that is preferential rates. Okay guys, so ordinary income is clear why we will have ordinary income if it is not satisfying these two conditions. So these two are important. Maybe in exam they can ask you something based on these two conditions. So please mark it important and understand it with logic. Okay, don't just mug up the conditions, don't mug up the chart book, right? It's whole logical, it's whole understandable, no need to mug up any criteria. Yeah, next one is tip income. On this, there was one question asked in the recent paper. It was regarding form 843. 843 is for taking the refund. Okay, refund of extra paid social security Medicare. On tip income also there was one question. I'm not sure what was, yeah, it was exactly the form number. 4137 form number was asked. So please understand it carefully, guys. Mainly in the restaurant industry, right? When you receive a tip income, along with your fixed income, you will also receive tip income. Okay. So on that tip income also, Medicare Social Security needs to be deducted. But how it will be deducted? Like tip income, only individual employee will know how much tip income they have received. So if they have received more than $20 in a month, then in next month till 10th of the next month, you have to include it. You have to report it to your employer. And when your employer will pay the Medicare Social Security, he will easily pay it along with that. But let's say your monthly income is less than, monthly tip income, okay, monthly tip income is less than $20, no need to report it to the government. No need to report it to the employer, okay. But the thing is, that doesn't mean if you're not reporting it to the employer, that doesn't mean it's not your income. Straight away, it needs to be included in your W2, in your 1040 also. But if you don't report it, still straight away when you prepare a 1040, include it in that tip income in the first line only, somewhere it is. Wages, salaries, tip, commission, all those things are included over there. Okay, so just let's read it quickly. Tip income to be included in income when all type of tip, it can be cash, non-cash, all type of tips received directly, charge tips paid by the employers, and tips received under a tip splitting or a tip pulling arrangement, where what happens, some of the restaurants have this kind of thing. Mostly they have tip splitting, means all the tips are collected and the end of the week it has been divided equally among all the employees. So when you receive under the tip splitting arrangement, it will be considered in your income. Okay, non-cash tips such as if you receive some tickets, some game show tickets, some passes, movie tickets, and all those things will be considered as your income. Straight away take the FMV of that ticket, okay, or whatever gifts you have received, non-cash things which you have received. Okay, so this will be included in the income. And next is when you need to report it. So you have to keep a daily tip record and you will be reporting it to the employer only if it is more than $20 in a month. So in the next month till 10th date you will report it. Now please remember one rule which is important. Usually people get confused. If you report it on time, that is before 10th of the next month, your tip income will be recorded as an income in that month. One example, December month. Mostly this issue take place in December only. December, January thing. So December you receive the tip income of $50. Since it's more than 20, so you have to report it to employer, right? So you will report it to the employer in which form? 4137 form, right? Yeah, 4137 form. And if you reported it before 10th of Jan, then this $50 will be included in the income in which month, guys? In January month, in the month reported, January. Now let's say you reported this $50 on 15th Jan. Okay, so you are reporting it after the deadline, so it will be included in the month in which it is earned. So in December month only you have to include this $50, right? So usually people makes mistake. It's not a cash accrual kind of thing, guys. It's just based on the reporting requirement. Tip income when you are reporting, and when you are reporting it in a delayed manner, when it should be included in the income. Okay, so it will be reported to the employer after 31st December and will be reflected on the employee's W2 in the following year if you reported it very well, okay, before 10th. So here is one example. You can just go through that example. I've already explained it. Next one is tip reported to the employer on time are considered in the month reported. Tips that are not reported on the time are considered income in the month actually received in December month. Okay, an employee who received tips of less than 20 in the calendar month, this is monthly, guys, aren't required to report the tip to their employer, but they must report this amount as an income on the tax return, and also they have to pay the taxes. Clear, guys? Tip income is clear. Now next one is treatment under employment taxes. Now whatever topics we have done till now, it was all related to employment related taxes. So let's quickly have an overview of it. Accident and health benefit, income tax withholding is exempt on that, means no need to pay any taxes if you receive an accident and health benefit from your employer. If employer is paying some premium for taking your accident and health, so income tax withholding is exempt. Social Security, Medicare is also exempt, and FUTA is also exempt. There is one exception, except long-term care benefit is provided, then it will be taxable through a FSA, flexible spending account, flexible spending arrangement. In case of Social Security, Medicare, including additional Medicare, also there is one exception, certain payments to S corporation where the employee who are 2% shareholders. Okay, so you will see in part 2, maybe in part 2 expenses, you will see this thing. When a S corp is going to pay something to the S corp shareholder and it is in the form of the health insurance, then it will be included in his income. How it will be included, how much is exempt and all, that we will see in the part 2. Okay, next one is achievement award. The condition is there are certain limits, you have to remember it. Okay, achievement award is something which will be paid once in the 5 years, right? And qualified plus non-qualified, the condition is it should be up to 1600 will be exempt. Only for non-qualified award 400 will be exempt. Okay, clear, guys? So you have to check how much qualified award you receive, how much non-qualified award you receive, and total of this, it should not be more than 1600, and only for qualified award it should not be more than 400. Here it should be qualified award only. Let me check on the next pages. Special rule for certain employees, interest, dividend, IRA is fine, deductible, distributions, death. Yes, in income exclusion we will see that thing. For qualified award it is 400, so please make the correction. For qualified award maximum 400 is allowed, and qualified plus non-qualified total 1600 is allowed. Okay, so 400 is for qualified, qualified plus non-qualified total 1600 is allowed. Okay, so this is achievement award. Next one is adoption assistance. See, when employer is going to provide some adoption assistance program to the employee, if they want to adopt a child and they are going to get some benefits from their employer's side, so in that case income tax withholding means federal income tax, it is exempt, but Medicare, Social Security is taxable. FUTA, SUTA is taxable, is liable to be paid. Okay, so please remember the differences. They might ask from which is taxable, which is exempt, which is allowed, which is disallowed. Okay, athletic facility, let's say the employer has provided athletic facility at the office premises, then it is exempt. It will not be liable for federal or Medicare, Social Security or futa suta. De minimis, a minimal benefit, right? Tea, coffee, snacks, all these things are minimal benefit, de minimis benefits. It will be exempt from all the three. Dependent care assistance, let's say a child care facility has been developed, so it will be exempt up to 5,000, and if a married person is going to file a separate return, they will get a benefit of only 2,500. Means up to this much, it will not be liable for federal income tax, Medicare, Social Security, futa suta. Okay. Education assistance, same way, just like let's say for example, my employer is going to provide me CPA sponsorship, right? So up to $5,250, if they are paying for my education, I'm not going to pay federal income tax, Medicare, Social Security or futa suta on that. Okay, up to 5,250, this benefit is each year. Employee discount, exempt up to certain limit, exclusion from the wages. Okay, so employee discount, if you're going to receive, being an employee, let's say you're working in any retail store, and to buy some goods from the same retail store, your employer is providing you some discount because you are working as an employee over there, right? How much you can take a exclusion if you receive a discount which is equal to 20% of the price of MRP, means just remember 20% discount, up to 20% you can easily claim without paying any tax of federal income tax, Medicare, Social Security, futa suta. One golden line I hope you guys remember, in regular class also I used to say this thing: any benefit given by employer to employee will always be taxable unless there is an exception. So these are all exceptions at one page. Okay, you can just remember this. For discount on merchandise or other property, your gross profit percentage times the price you charge to non-employee customers for the property. Okay, let's say if you're going to provide the discounts on merchandise, so straight away take the gross profit percentage, what amount of gross profit the whole retail store is earning, straight away that percentage, that much discount you can claim. 20% is for services. Okay, let's say a person is working in a beauty salon and they want to have their haircut. Okay, so they can get a straight away 20% on the services, right? Let's say a person is working in some retail store, now he want to buy some electronics, straight away he get a discount which is equal to the gross profit percentage of the whole retail store. Next is group time life insurance, which we have already seen. It will be exempt from federal income tax, but yes, it will be exempt from Medicare, Social Security only up to 50,000. Over and above that, it will be liable for Medicare, Social Security, right? Next is health saving account. It will be exempt for qualified individuals up to the HSA contribution. So for the calendar year 2023, the qualifying highly deductible health plan, HDHP's highly deductible health plan, must have a deductible of at least 1,500 for self coverage and 3,000 for the family coverage. So this much you can easily deduct for yourself if you are investing into the health saving account, right? And out of the pocket, this same topic you will see again in the income exclusion. Okay, so don't worry about it. And out of the pocket expense you can easily incur for $7,500 for self coverage and 15,000 for family coverage. So do you remember, like in schedule A, right? Medical expenses are there. If you have incurred some medical expense, also you are withdrawing money from health saving account, so you can take out of pocket expense of $7,500 or 15,000, and you can take this two deductions on schedule A, medical expense as well. These two amount limits are allowed. Okay, so that's why it's mentioning out of pocket expense, right? So next one is lodging on your business premise. Lodging means, let's say, the facility to stay at the employment place due to some, let's say, busy tax season is there, or due to some important client work, you are given a lodging, a stay, overnight stay at the business premises. So that will be exempt. Okay. Next is meals. Meals, no need to provide any Medicare, Social Security, futa suta on meals. Okay, if it is furnished on the business premises, let's say the busy tax season, you are going to receive the meals on Saturdays, you are working, the employer will provide you meals, so no need to charge any Medicare, Social Security, futa suta, federal income tax on that. Okay, Next one is no additional cost service. Let's say there is a retail store which is selling some electronics. Okay, so they also repair the electronics. Now the employee who is working there, his one of the laptop is damaged, so he is going to give it for the repairing purpose to his own employer store only, and when he gave it, it is done free of cost, and there is no additional cost, there is no part replacement or anything. They are just going to use the skills, and there is no additional cost incurred to improve that laptop. Then no need to consider it as you are providing benefit. Okay, no need to charge federal income tax, social security, Medicare or futa sota. Same way, retirement planning services, I am saying about services. Okay, let's say all the employer has opened the bank account for all the employees, the retirement account for all the employees, so it's just providing the services. They are not actually depositing yet. For that we will later on see 401k, SEP and simple plan, but they are just providing like this, just the knowledge about the retirement plan, just helping to open the retirement plan, just planning out the retirement plan strategies. Those all services they are just providing, then it is exempt. Okay, transportation, that is commuting, so it will be exempt. Commuting means, let's say from home to office, if you're traveling, and if the employer is going to provide you the transit pass or some parking or toll charges which the employer is going to bear for you so that you can come and work at the office place, so that will be exempt from any taxes. Next is tuition reduction. If for undergraduate education or graduate education, if employee performs the teaching or research activities, right, then it will be considered as a tuition reduction and it will be exempt. No need to make it chargeable for federal, Medicare, social and futa sota. Working condition benefit means if you are going to work here, let's say some of the workers are going to work at the construction site. So if you are working there for this much hours, the employer is going to provide you the meals. Okay, lunch, dinner, high tea, everything will be provided by the employer. So due to your working conditions, they are going to provide you some benefits that will be exempt. Okay, clear guys? So these are the all employer-employee related benefits I have covered over here. But just remember, if anything which is pending, it is there in the remaining parts of the book. Next is additional points. See, for 22, as in 21, 2019 and 18, there is no limitation on itemized deduction, as that limitation was eliminated by Tax Cut and Job Act. Okay, so for itemized deduction, there is no limitations for TCGA. Okay, based on TCGA. For taxable year beginning 22, previous year only, the dollar limitation for employee salary reduction for contribution to health flexible arrangement increases to 2850. So these are just the amendments. I can say some additional points which were added in previous year only in 2022. I hope those who have already seen the previous year's book, they might be aware about it. So for the taxable year beginning from 22, the dollar limitation for employee salary reduction for contribution to FSA. Okay, if the employer is going to make some contribution to FSA on behalf of employee, from employee salary, how much FSA they can contribute? Maximum 2850. Earlier it was some another amount, but now it has increased to 2850. Also for cafeteria plan. Cafeteria plan means all the retirement benefit related plans that permits the carryover of unused amount. Okay, so the maximum carryover amount will be 570, an increase of 20 from the taxable year beginning 21. Next one is, if you are going to participate, like if you have participated in a self-coverage medical MSA plan, medical saving account, the plan must have been annual deductible. The plan must have an annual deductible that is not less than 2450. No need to remember this all things. This is just a quick amendments which came in the previous year since 2022. What all things are added on. Okay. All right, whatever is important, I'm just going to cover from the exam point of view, not each and everything, because in detail we have done in the regular class. All right, now comes the special rules for certain employees. If an employee is a church employee, okay, for them, I'll just quickly explain you in a very short manner that whenever the church employee is going to receive the income, and if he's defined as a member of religious organization. He's an ordained minister. He will be considering that income as a Schedule C self-employment income, and self-employment taxes will be applicable. That's it. It will not be considered as a W2 wages. Please remember this thing. Now we are going to include in income any salary and fees received from the masses, marriages, baptism, funerals, etc. Okay, anything which he receives for performing these services will be considered as his salary. Exception, we will see if it's an ordained minister, we will see the exception. Rest all, they will consider it as a salary. Now, payment to the religious institutions are non-taxable. Okay, if the let's say there is a marriage, so the family are paying the amount to the church, not to the person who is going to perform the whole marriage. Okay, so whatever has been paid to the church, that the person who is going to perform the marriage, he is not going to make it taxable. So payment to the religious institution is non-taxable. Then member of a religious organization who gives outside earnings to the organization must include that earning as an income and may take a charitable deduction to for the amount paid to the organization. Just a simple logic is there. Let's say one of the there's one accountant. Let's say one lawyer is there. Okay, he provide the advocate services and he is going to earn a huge amount. And since he is believing in the church, in that he is of that religion, so he goes on every Friday to the church. So every Friday he donates his earning. Whole week he is earning. Whatever is his Friday's paycheck, from that he donates 50% of the earning. That doesn't mean whatever earnings he is going to earn from the advocate services is exempt. No. First, everything will be included in the wages income as an income, and later on it will be deducted in the form of charitable contribution. Clear, guys? Now, one more thing is, look at the last one. Member of religious order. Now, if the services are performed for the order and the services are performed outside the order, for the order means based on the wages a member earns as an agent of an order and turns over the order to the church is not included in the income. Let's say the church has conducted one charitable show, or the church has conducted some exhibition. Now you are just performing voluntarily based on the orders given by the church. Okay, that you have to set up a exhibition, some decoration work you have to do, some whatever performance you are going to do, and at that time you collect the donation from the normal public, and straight away you are transferring, like handing it over the donation to the church, right? So it's not your income, it's not included in your income, right? Next one is services performed outside the order. Outside the order means the accountant, the lawyer example. Okay, then it will be first included, and when you donate it to the church, it will be excluded in the form of charitable donation. What is the one exception? Services that are ordinarily the duties of the member of the order. Let's say the church employee is there. His duty is to perform those things. Okay, let's say there is one person who is hired by the church just to send the beverages and milk from one church to another church. So that person is performing it as a duty to the church. Plus, there are part of duties that the member must exercise for religious order as its agent, right? So in that situation, it will be excluded. Else, just remember the example of advocate and accountant, or any professional person, or any person who is just donating his income. That doesn't mean he's performing the services outside within the order, and it should not be included in the income. It should be included, and later we will take the exception. Sorry, deduction. Only this thing you will get confused with this thing. If a person is going to provide these services that are ordinarily his duty, when it will be his duty, he is a part of that church. Okay, they are performing some prayers, they are singing in the church. That is the duty. They are hired for that. Not hired, but they are going to perform it because the position is at a, let's say father is there, so at that level the position is there and they have to perform those activities, right? So in that situation, if you're going to earn some income, it will be straight away go to the church, no need to include it in income. Clear, guys? So don't get confused. Read the theory properly. This is just a revision. Again, I'm giving a disclaimer. So see, if you're going to receive a housing and pension, right? And if the services are rendered as a ODient, a licensed or commissioned minister, then whatever is the rental value of the home plus utilities plus designated housing allowance, these three things will be excluded from your W2. Why? It will be included as a self-employment income. That's it. You have to remember main thing. If you fall under any of the category that is ODient or licensed or commissioned minister, then the rental value of the home which is paid by the church, okay, the utilities which is paid by the church, any housing allowance you are receiving from the church, these three things, if it is utilized for that purpose, it will be used, it will be considered as a self-employment income, not a W2 wages. And pensions will be receiving a normal treatment. When you receive it, it is taxable. If you have a church employee and who is going to receive $108.28 or more, you must pay a self-employment tax. The person will be paying a self-employment tax for that. I think, yeah, in regular book, please go and check our regular book. There is one example on this, very well drafted, okay? The amounts and all is given. So please refer that to understand this housing related allowance. Next is foreign employer. If your employer is a foreign employer and you are receiving some income from that, so it is not considered to be wages for Social Security, Medicare purpose, but it will be considered straight away as a self-employment if income received, if you are receiving it as a US citizen from an international organization, and you will be paying a self-employment taxes. Okay, please remember this thing. In case of clergy, foreign employer and member of religious order, there are certain conditions. Because of those conditions, your income will not be your W2 income, but it will look like you're receiving wages, but it will fall under this self-employment income, and self-employment tax will be applicable. Next is military pay. So you are going to report the payment received as a service member, as wages for the tax purpose, except for the retirement pay. If you receive any wages because of you are a military member, so wages will receive a normal treatment. But yes, if you receive a retirement pay, then it will be non-taxable. Okay, non-taxable in the sense non-taxable as a wages, but yeah, it will be taxable in the form of pension. This is just a categorization which category it will be taxable, because as soon as you include it in wages, you will be liable for Medicare, Social Security, FUTA, SUTA. To save yourself from this all taxes, you have to put a proper categorization. Clear, guys? So these are some special rules for certain employees which we have seen. Next one is our passive income, interest income we are starting. Okay, so if you are receiving a interest income, it will be taxable. So interest on federal bonds, what all will be taxable? Federal bonds. In exam, there can be indirect question. No one is going to ask you straight away a simple one-liner question on this topic. Somewhere in the calculation of gross income, this topic will be there. Okay, so see, interest on the federal bond, premium received on opening the bank account, if you receive some discounts on that. Okay, and if $10 or $10 benefits you are going to receive, then also it will be considered as an interest income. And if the balance is more than 5,000, then $20 benefit you might receive, that will be considered as an interest income. Okay, interest for the late payment of the tax refund. Okay, so let's say you are going to get a refund, but due to some reason your refund is delayed, and for that the federal or state or local government is going to pay the interest on that refund. It will be also be considered as a taxable. Next is interest on deferred payout arrangements. What are deferred payout arrangements? One example is there. See, Mr. X dies, but his nominee gets the amount. So if the nominee can opt to get, let's say, $1 million today, and he is going to accumulate it to $1.2 million for next 20 years. So after the date of death, after the date of death, then whatever extra 0.2 million he's going to get now as a deferred payout arrangement, then it should be considered as a interest income, a taxable in the Schedule B interest income, right? And the last one is interest for seller financed mortgage. One more example is installment sale. When you're going to have an installment sale, or a seller, whoever is going to sell, he is only going to finance the buyer's mortgage, right? So when he receives the interest, or when he receives the interest payment for installment sales, that will be considered in the interest income. In 1099 INT Schedule B will be considered whatever amount if you receive as an interest is more than 1500, or if it's relating to bank account opening, $10, $20, then you have to mandatorily issue a 1099 INT. Whoever is paying the interest will issue you the 1099 INT. Okay, clear guys? I hope this much is clear. Next is non-taxable but is still reported on 1040. What are those interests? First one is interest on state or local government tax-exempt interest. I can say this is tax-exempt interest. If you're going to receive an interest from the state or local government bonds, in bonds if you're investing and you start receiving the interest from them, then it is a non-taxable. Next is Series EE bond, and if it is used, the interest part I'm saying, guys, the interest part, if you're using it for higher education purpose, then it is non-taxable. Okay. Next is OID, that is original issue discount. OID is what? Let's say, straight away I'm taking this example, okay? Redemption value, whatever is the redemption, let's say today you bought the shares at X price, but after 10 years, the redemption value will be obviously be higher, right? So redemption value minus issue price. Okay, whatever is the difference, if this is less than a certain amount, what is that certain amount? Whatever is the redemption price into 1% into number of years. Let's say it's a 10-year bond, 5-year bond. Okay, so take the total number of years, take 1% into 0.25. So this is the formula given by the IRS. Okay, if you can remember, that's good. Take straight away the face value, that is redemption value. Okay, after 5 years, let's say it's a 5-year bond, and the redemption value is $100. Right now you bought the shares at $50. So $100 into 1% into 5 years into 0.25. This is your limit, I can say, up to this much amount. If you are going to have a difference between face value and the issue price, if this difference is within this limit, then no need to include this as a interest income. Else this is your interest, right? You have earned this much amount, so it will be interest. But as soon as it is more than this price, then capital gain will be charged at the time of maturity, and also this much portion will be charged as an interest income. Okay, I hope you understand this. Now one more thing is there in interest income. When you have a joint account, right, one person, the 1099 INT will be issued in the name of the one person only. Okay, so since it's in the joint account with, let's say Mr. A, Mr. B, both are owning the bank account jointly, and the interest income is issued in the name of Mr. A. So Mr. A will include only his proportionate amount, and Mr. A will issue a 1099 INT to Mr. B, who will include his proportionate amount in his tax return. Okay, so joint saving account in the name of the taxpayer, 1099 INT received in the name of only one taxpayer. So include the full amount in the taxpayer's return as an inflow, and the proportionate amount of Mr. B's will be excluded from the tax return, and the B will include in his return based on the 1099 INT which A will issue. Right? Got it, guys? So this is about the interest income. Next one is dividend income. So this is also very simple. Whenever you invest into some corporation, see, corporate C Corp will only issue the dividend. S Corp partnership is not going to issue dividend. So whenever you're going to invest into the C Corporation and they are going to pay you dividend, they will be giving you a brokerage statement, or else they will be giving you a 1099 DIV. Looking at that, you will figure out whether it's a ordinary dividend, whether it's a non-taxable, whether it's a capital gain distribution, or whether it's a qualified dividend. For our EA exam, the meaning is important. What do you mean by ordinary dividend? Just a normal dividend distribution in the form of cash, in kind. Okay, so it's a normal ordinary dividend distributed from the company's profit. If company doesn't have enough profit, So up to your basis means how much you have invested in the corporation, up to that much amount, it will be called as a non-taxable return on capital. Return on capital, or you receive a stock split or stock dividend. Third thing, you receive more than your basis. Whatever you invest, let's say you invested only $100, but you're receiving as a dividend $500. So extra $400 will be your capital gain distribution. Okay. Now please understand what is qualified dividend. Whenever you are going to invest into some stock, shares and securities, you need to check the holding period. If you are holding for more than 60 days, now this 60 days will start from the date of declaration of dividend. That is ex-dividend date. Ex-dividend is just one day after the date of declaring the dividend. From that day back calculate the 60 days. Okay, from this date front calculate 121 days. In this 121 days, you should be holding the shares and securities for at least 60 days. Stock which is held for more than 60 days out of this 121 days, starting from the 60 days prior to the ex-dividend date. Okay, clear guys? So this is called as a qualified dividend, and qualified dividend will have a preferential rate 10%, 15%, 20%. An ordinary dividend will be considered as a normal dividend income. It will fall under the normal slab rate. You will receive either 1099B brokerage statement or 1099 DIV. Okay. Next is reinvestment plan. Amount received by the mutual fund or REITs or non-dividend distribution, stock and stock rights. This all taxabilities are given if you are having a reinvestment plan. So FMB of additional stock. Reinvestment means whatever dividend you are going to receive, you're not actually receiving it in the bank account. Using that dividend, you are investing it in the another stock, same company stock. So report it as a dividend income. Even if you're reinvesting in some plan, you should report it as an income. Okay. Now amount received by the mutual fund or real estate investment trust. So report those as a long-term capital gain, which form 2439 Schedule D. Okay, from mutual fund or REITs, if you receive anything, any income, straight away it will be LTCG. Okay, got it guys? Next is non-dividend distribution. Up to the basis, it is non-taxable. More than basis, it will be taxable as a capital gain. Next is stock and stock rights. Only the common stock. Please remember, there can be a question from this topic. Only common stock are issued to all the members, then it is non-taxable. Preferred plus common, the option is given to everyone, or some people are getting preferred stock, some are getting common stock, then all of them will be taxable as a dividend. Only preferred stock is also issued, then also it is taxable. Please remember, only one exception is there, that if you issue a common stock, only common stock, equal rights, everyone will have the same type of stock in the form of dividend, then it is a non-taxable, else it will become taxable. Okay, so now next topic is IRA. IRA is a kind of bit important. So we'll hold the session right now over here, and the next lecture maybe you will find the whole IRA topic in detail. Social Security benefit, rental income and expense, and business income and expense. So these all topics we will be doing in the next session. Yes, and there is also carry forward of the losses and additional income alimony. So almost the income chapter will be completed in the next session. So that's it for the day, guys. Thank you. Have a good day. We'll meet in the next lecture. Have a nice day. Bye.